Well, good morning and welcome back to the FEG tax package. This is a package, not just a plan, because it really is the basic understanding of what's going on, mixed with understanding where to look for changes and then what strategies or concepts that you can employ. And again, if you want to do this on your own, God bless, that's your business. If you're looking for a fiduciary, the Financial Enhancement Group's ready to have a conversation with you. We'll take you through the next steps meeting where we'll give you things you're going to want to consider right now, things you're going to want to consider in the future. And if we choose to partner together, what FEG will do for you, and we'll put it into writing. So you can get signed up for that at yourlifeafterwork.com. Just simply go to next steps, and Brittany will get you on the calendar and the schedule. In the meantime, we're working on your tax planning strategy, things that you need to consider. And these are things that FEG already does for you if you're part of our family, but they're things that you have to give us the information about. So we spent the first 3 different videos talking about understanding your tax return, why it's important as a fiduciary that you pay attention to the tax planning journey, not just the one-hit wonder. Also understanding the difference between tax planning that has to happen before year end versus tax reporting, which is what most of us do with our CPAs. We talked about there being 2 different codes, one for the informed and one for the uninformed, and making sure that you're actually applying the observations that we have and the things that you can use out there. So that gave you your understanding. Then we talked about how to read your return so you know what your adjusted gross income is, you know what your standard or itemized deductions are, you know what your taxable income is, and then you understand the concept of the stair steps. And if you've missed any of that, simply go to fegtaxpack.com or 833-TAXPACK. You can call that number, and we'll get you hooked up so that you can get the videos that you've missed, because it really is a series of building blocks of things that you need to understand to be able to get in different directions. Last week, we talked about income variability. So you've got your marginal rate, the last dollar that you have that was taxed. And if you remember, the best way to understand our tax system is to think about this series of stair steps where you're able to go to line 15, if you will, on your return, and that tells you what your taxable income is, at least for last year, your taxable income, and each dollar, right? So you've already got your deductions or credits marked out that you've taken. Above here is your AGI up here. You've taken off your deductions. Line 15 tells you your taxable income from last year. That very first dollar was taxed at 10%. If you were married filing jointly, the step is deeper, meaning you can have more money taxed at 10%. If you're filing as a single individual, it's a shallower step, less money, but the first dollar is still taxed at 10%. And then you move to 12%, and then you begin to go to 22% and higher after that. So last week's assignment was really understanding income variability. It was looking at the different things that could have changed in your life that will change either the amount of income that's on your return, so that your taxable income this year would be higher because you got a bonus, a raise, you sold property that had to be recognized in gains, or smaller, you quit your job, retired, whatever. And then marital status, this married filing jointly, or whether you're a single individual, however that worked. The concept that I want to get you to right away is understanding you're on a financial journey, and this is in no way condemning. Every now and then somebody comes in and we have a conversation and they put their head down and they go, I thought I was doing it right. Well, ladies and gentlemen, we cannot make up for anything that was done yesterday. And it really doesn't even matter why. Doesn't matter how the mistake occurred or how we got to where we are. The challenge is we are where we are, and we have a financial journey, yours, that we have to help you unfold to put you in the best possible situation. And the bottom line is a lot of people who come to see us didn't have the opportunity to contribute to Roth IRAs along the way, and worked at a company or as a doctor or as a teacher or as a firefighter, and they worked someplace where the majority of their money is what we call tax deferred. In other words, they didn't pay taxes on it today. They paid They deferred those taxes under the theory from a long time ago, under the theory that when they retired, they would pay lower amounts of taxes. Now, it is true when you retire, you won't pay Social Security tax on passive income. You only pay that on earned income. Now, what most people don't know is when you put money in a 401k, you are still paying the Social Security tax today. That's not deferred. That's why you don't have to pay it when you pull the money back out. But the theory was that you would be at a lower taxable income when you retired. Now, for some people, very, very few, that may be true. What I have found is when most people go to separate from the workforce, if they have adequately prepared, and that's our job to help you with, the Financial Enhancement Group, it's to make sure that you're able to maintain your standard of living. And the majority of people's standard of living is very, very similar to the taxable income that they had previously. Right? So there's not usually a big drop in terms of where they are, but we want to look at that income variability. We want to deal with the fact that most of you, when we look at your tax diversification, and this is always odd to me, people who don't manage money pay attention to the diversification because they've been told to, between stocks and bonds and cash, or growth and value and international, but they don't pay attention to tax diversification. When we look at your tax pot, there really are three places that you can have money. There's money that's exposed to the IRS every year. That's taxable. That's where interest or dividends or capital gains would go. There is tax deferred. That's your IRA and 401k. And then there's tax free. Tax free primarily comes from the Roth. And again, a lot of you didn't have the opportunity to contribute to a Roth 401k. We're in 2022. We still have less than 30% of all the 401k plans in the country that allow for Roth contributions. So it's not your fault. This is not me condemning. My point is, when I look at most people's accounts when they first come in, it looks like this. And all of this money is tax deferred. It is money waiting for the IRS to take their pound of flesh. What our team at the Financial Enhancement Group would help you do is understand the concept of bracket bumping. Most of the families we take care of cannot stay inside of the 10% bracket, but most of them really don't need to be above the 12 once they've separated from the workforce. They don't need to be above the 12. Most of them find their taxable income would put them somewhere at this level. So their marginal rate's 12%. Remember, anything on that stair step would be 12. Their marginal rate is 12%, but there's a lot of room left that's still at 12%. Right? Now, we know per the IRS that more than 70% of the money that's inside of tax-deferred plans isn't accessed until people turn that magical age, now 72, used to be 70 and a half, when they're forced to withdraw the money. And so people who are doing this on their own very commonly leave the money in these tax-deferred accounts because that's what you were taught along the way. Let it grow tax-deferred and get bigger and bigger and bigger. And that's fun. Growth is good. I manage money. I'll squeeze nickels. I got it, right? That's all well and good. The problem is your tax return is a one-hit wonder. And what we help people do, especially when they're over 59 and a half, and when they're under 59 and a half, so it's both sides, what we want to do is help people take money in this tax-deferred side and divert your pie so that the tax-deferred percentage decreases every year and the amount of tax-free is actually beginning to grow. Now, how do we do that? Well, we look inside of your tax-deferred area. We look inside of your tax bracket, and we find this magical space. And let's say we could have added $25,000 of taxable income to your return last year, and yet you would still be inside of that 12% bracket. We call it bracket bumping. And what we're going to do is take that $25,000, still keep you at the same marginal rate. We're going to take $25,000 from the tax deferred, and we're going to convert it into a Roth IRA. That's bracket bumping. Maybe it's money that you know you're going to need in a year or 2 years, or money you want to gift to your kids. You don't need to worry about the Roth then, and we'll talk about the Roth in another strategy in more detail. It's just the idea of making use of that 12% bracket. Right? The IRS gives us a set of rules. Rules are not to be picked and followed that best suit the IRS. They're designed for you to comply. That doesn't mean ignore. We're not talking about cheating. We're talking about to be effective, efficient taxpayers in the United States. Do your part based on what the rules are. Remember, there are two tax codes, one for the informed and one for the uninformed. If you're going to do this on your own, it is your job to be informed. If you're working with a fiduciary, it is our job to be informed and to help guide you, to collaborate with your CPA who does the tax reporting, not the tax planning usually, to help people get in this right area. Tax bumping, or bracket bumping rather, is one of those strategies that you can use based on what you learned in the first few videos that we sent. Again, make sure you know how to read your return, understand the concept of the stair steps, look for any income variability that's going to occur, know what your marginal rate is, and let's start using some of these strategies. If you missed any of them, do not forget, you can go to fegtaxpack.com, P-A-C-K, taxpack.com, FEG, and we'll happily get you signed up, get you into the first video so that you can build on that building block. You can call 833-TAXPACK, talk to Brittany, also get hooked up into that system. And if you're ready for a next steps meeting, we're more than happy to invest 90 minutes of our lives with you, where we will give you things to consider today, things you're going to want to consider in the future. And if we choose to partner together, we'll tell you what FEG will do for you to take that load off your back, and we'll put it into writing. That's at yourlifeafterwork.com. In the meantime, keep paying attention to the tax return. You're on a good roll. I congratulate you for getting here. Next week, we'll talk about the double stack. Have a great week.